Employed, self-employed, business owner, employer, it doesn't matter, I've got some bad news for you. As business accountants, my team and I spend all day long helping business owners on their journey. And of course, when there's news, big news that is impacting everybody, it's good to come out and talk about it. And I want to talk to you about something that was actually announced at the back end of 2021, but now we're going to start to see the impact of it as it comes towards April 2022. And that's the Health and Social Care Levy, which is effectively an increase to the national insurance we all pay across all sorts of business and income sort of styles. And that's what I want to cover in this video. And at the end of it, I'm going to tell you a few tips around how you could help reduce the impact of it. So before we get into it, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So what is the levy? Well, this new levy, the idea of it is it's to help fund at least the NHS and social care moving forward. It's a big problem we have in this country as people are living longer and all the rest of it. So this was announced, and the idea is it was going to be like a separate tax. Actually, HMRC's guidance even told employers to kind of state on the payslip what it was for. They wanted to make it clear to people that this is a new kind of thing. However, technically at the moment, it's effectively a increase in national insurance. For legal and different interactions with tax later on, it'll be its own thing. But right now, it's an increase in national insurance of 1.25%. And I'm going to talk to you about how that really works out in a minute in terms of your pay. But if you're an employee, it just means you're going to be effectively taxed more and take home less money. If you're a self-employed person, you pay your national insurance in your tax return at the year end. That bill's going to get bigger. If you're an employer, you pay currently about 13.8% on top of your employees and your team's wages as a cost to you. That's going to go up by the 1.25% as well. So that's at 15.05%. So that's a pretty chunky increase. So regardless of your situation, you're going to end up paying more tax somewhere along the lines. To get a feel for how that would actually impact your pocket then as an employee, if you thought, let's say you earn £24,100, you're looking at losing about £15 a month out your pay. If you earned a bit more and you earn £67,100, for example, so you're what they call like a higher rate taxpayer, you're earning over 50-ish grand a year, then you're actually going to lose £59 a month. That's quite a significant chunk, I think, out of there, on top of, rising energy bills and inflation and all the other things that are in the media at the moment, but I'm sure you've heard about those. It's going to feel quite tight. So that's all coming, and it's one of the reasons why this has made the press, is because they know, combined with these other things, it's going to hurt some people. So there you go. Now, the self-employed example of that sort of tax amount is going to be very, very similar. The rates are slightly different, but you can kind of get that sort of feel for it. But there is something you can do about it, which I'll cover in a minute. Now, you might think, listening to this, sweet, I'm a limited company owner. I take most of my money in dividends and only a small amount of salary. There's a video on this if you don't know what I'm talking about, which I'll link. And therefore, my dividends don't have any national insurance. I avoid this. Unfortunately, the policymakers kind of thought of this, and what they did is they're going to increase the dividend tax by the same percentage. So this kind of dividend rate that they've got, or dividend tax as it's more commonly known, is going up 1.25% as well. So that 7.5% dividend tax you would have received is now going to end up going up by the 1.25 as well. So again, another chunky hit. I think if you're a limited company employer or even sole trade employer, you're really going to feel that. I mean, limited company tax itself, the corporation tax is due to go up. You've got increased pay rates. You've got now this increase in national insurance to your cost, taking over 15% now, which is a pretty chunky sort of tax on your team. And then when you do finally get some profits to take out, you're then going to be taxed even more money on your dividends. So it's still very tax efficient to be a limited in the right scenario, but as an employer particularly, there's a lot of cost implications there to think about moving forward, especially around your pricing and things as we move towards April. So I'm sure we'll do some more videos on that. But do know the whole thing is going up. Now, finally, on employers, if you do claim employer's allowance, and again, there's another video on that you should check out to explain how that works. It's kind of a tax relief that allows you to reduce some of your cost in terms of that national insurance you've got to pay each year if you're eligible. You are currently able to use that. So if you're one of these smaller employers that doesn't use the whole amount that you have every year, you might be able to offset some of the cost. But I don't want to go too deep into that video, but do check out our employer's allowance video on that topic. So what can you do about it? Well, let's talk self-employed people first. Unfortunately, with all of the classes of people, you can't avoid it. There's no secret kind of formula to avoid it. It's across all of the different taxes. They've done a pretty good job of making sure that's the case. But what I would say is that if you're self-employed, you want to make sure you're keeping good records. I say it over and over again, but the reason that is that you're going to be able to make sure you're only declaring the right amount of profit, because this social care levy and national insurance is all based on how much profit you make. So if you make lower taxable profits, you're not not going to pay as much in national insurance and ultimately this health and social care levy. So keeping good records is going to allow you to make sure you're claiming for all the things you should be claiming for. Get educated, watch the videos on the channel, speak to accountants, make sure that you're keeping all the reliefs and all the expenses you could claim, and if your profits are down, you're going to be in a good situation. And that applies generally to tax as a whole, but particularly worth sort of refocusing with this extra kind of charge that's coming. If you're a limited company, then obviously the dividends are going to be an issue because you're going to have this extra rate rise that's occurring. But what I would say on this is that what you might want to do is if you've got a pot of money there and you're thinking about what dividends you want to take, as we move towards April 2022, you may wish, if you've got the profits to do so, to sort of note a dividend in your accounts up front. So you taxed it in this tax year while it's still cheaper before going into the other tax year. It will very much depend on your situation, but do kind of put it as a planning point to speak to your accountant about, or consider if you're doing your own maths, see if you've got any allowances left to make use of sort of an advanced dividend. So bear that in mind. And of course, if you're a limited company owner, you want to make sure you're taking out all of your money as tax efficiently as possible. If you've got an arrangement where you're in there as a husband and wife in the company, have you got the money coming out to the both of you split correctly? Have you got different shares going on? Like what can you do to make sure that any of that money coming out is already efficient? Because again, the better split and the better way that you take it, the more those rates are going to end up being reduced in terms of the impact on you. The rates are the rates, but if you can reduce the kind of amounts that the rates apply to, then that is all going to be helpful to you. And then a final note for employers, I don't want to go too deep into this, but there is what they call salary sacrifice arrangements you could potentially do if people want to put more money in their pensions. It will lower their wages and therefore would lower the social care levy, but it's a minor point. So if you're into people putting into their pension schemes, consider looking at a salary sacrifice scheme, but minor point. So there we go. Simple things you can do to reduce the impact. Well, that's it. Hopefully you've enjoyed this video. If you know anybody that needs to know this information, please do share it with them. Like, subscribe, and I'll see you in the next one.